I'm going to put up a chart here, actually, of the spread between BTPs, the Italian bonds, and the Bund, the German bonds, which shows that they're shooting up again. They're just under the 300 basis point level. So let's start with Italy, and then we can expand it out from there. To what extent is this a fundamental risk, or is this just more of the same? We've had, what, 50 governments in Italy since World War II, something like that. Is this just more of the same, or is this indicating something more fundamental?
Well, it's definitely creating a lot of uncertainty in the European Union. Our view is that it will remain quite localized. There's a lot of negotiating going right now, but we think it'll stay within the Italian region. One of the issues we've been dealing with this year is the difference in returns between U.S. and non-U.S. markets and that gap. And we actually believe that with some of the tariff issues and some of maybe the strong dollar starting to stabilize over time, we might start to see more of parity between market returns, especially in the European Union, where you might end up with a silver lining from all of this, which is that the EU could start to push out tightening, which would be a positive for the markets and allow them to grow a little bit faster.
Quite apart from the Italian budget crisis of the moment, does European growth rate support your thesis? Because it has been softening somewhat.
Yeah, so current European growth rates don't. They're in the low single digits, positive territory. That's not really a great story. What you need is a catalyst, which would be the European Union pushing out tightening. And also, the European markets are cheap, so they're reflecting that. So we don't have a lot priced in here. So basically, we can get some kind of positive news or catalyst going forward, it'd be positive. And that if you look at U.S. markets versus the rest of the world, they're at basically premium levels that you haven't seen over the past 10 years. So we're really getting to a stretch point where the international markets could rebound. When
you talked about the catalyst, you said putting off tightening. So you're really talking about the ECB backing off. Do we have any indication that they're inclined to do that?
We don't have that yet, but if growth continues to slow and we see more uncertainty based out of Italy, which overspills into the rest of the European Union, we could start to see talk about that.
So, Saira, where in Europe would be on your shopping list?
Definitely Northern Europe, cyclicals, if growth can start to increase, which is, we did see a rebound in 2017, so we have seen part of a recovery there. If we can see growth start to increase there, we'd be looking at Northern European industrial companies that are tied to the economy.
Would you have to see a significantly weaker euro for that, or just stabilization?
We'd see just stabilization, I think, and an increased growth rate across the board.
So, Saira, let me come back to something you referred to, which is the disparity, growing disparity, basically, between your returns and equities in the United States and the rest of the world. We'll put a chart up right now, which is basically the blue line is the S&P, the white line is MSCI World minus U.S., which illustrates exactly what you're talking about. You think that's going to revert to a mean. How's that going to happen?
So a few things will happen. First of all, in the U.S., you're starting to see more headwinds. So on a valuation basis, as the S&P gets through 3,000, it's starting to trade at a premium valuation. More headwinds, such as increased inflation and increased rates, make the story in the U.S. less appealing. We could talk a little bit more about how growth stocks are starting to show cracks in the U.S. Outside of the U.S., you're seeing some positives, actually. Beyond these clouds of tariffs and a stronger dollar, you're starting to see China put in stimulus. The EU could react, and the dollar could stabilize, and that would be positive for those markets, which already have the valuation story in place. So it's a matter of just now starting to see some of these headwinds ease outside of the U.S., and then the valuation supports an upswing. So kind of a dampening return in the U.S. going forward and increased returns outside of the U.S.
Yeah, Saira, I love that you brought up growth stocks, because it's been about those high-yielding dividend stocks, it's been growth stocks, it's been small caps. How do you think that those trades are done, or do they still have a little bit more room to run before you need to make the turn to the large cap internationals and value?
So growth stocks, we would just recommend starting to take some off the table. There's some really nice sustainable growth stocks that still have a lot of runway left for them. But as you saw in second quarter earnings, some stocks had pretty high valuations, and that led to some cracks when earnings weren't as good as we expected. The market's been shifting more into defensive. We also think cyclicals could be of interest, as they've underperformed for a number of years now. That a bit depends on where we see tariffs and inflation going. If the market continues to have a lot of fear, we think some defensive sectors such as healthcare, even consumer staples selectively could start to do well. But if we get slowly higher rates and growth remains intact, which is more the view that we see, then U.S. cyclicals could finally start to take over leadership, and it won't be just such a narrow growth-oriented market.
What's the biggest risk then to that view?
Our biggest risk to our view is basically the wild card around tariffs, particularly China. If that really starts to become more of a reality and hits the numbers, you'll start to see higher inflation. And also anecdotally, you saw Amazon today lifting minimum wage. All of that could lead to higher inflation. Then we get to the Fed where they overshoot rate increases, and that would pull forward the end of this bull market cycle.
So there's a lot of concern about how far we are into the cycle. And of course, we keep hearing that bull markets don't die of old age. Right. But we'll put up a chart actually that we ran across from MLive that that's interesting that suggests that actually, as much as this market has run, it has not run as far and as fast as some earlier markets when they've been bull markets, so which might suggest we got further to go.
So earnings growth is what drives bull markets higher, and if we take a step back, that is completely intact, especially in the U.S. Double-digit earnings growth last quarter to this quarter, even into 2019. As long as that stays in place, I think the bull market continues through 2019, but just at lower return rates than we've seen before. The issue will be, though, the bull market will die if we get to higher inflation and the Fed overshoots interest rate increases, and eventually that'll just cause your classic end to a bull market cycle where we go into probably what will be a mild, shallow recession.